Hi friends, welcome to the NPTEL course Business Development from Start to Scale. We are in week 9 with the theme of business development structures. In this lecture, the 45th in this series, we discuss the topic of mergers and acquisitions. Mergers involve joining together of two firms to create a new larger entity. Acquisitions involve takeover of a company or its business by another company. Together, these are called mergers and acquisitions or M&A. These are of multiple types as discussed in this and subsequent slides. There are four types of mergers: horizontal merger, vertical merger, absorption merger, and conglomerate merger. If a merger happens in the same business, it's called horizontal merger. It helps overcome competitive weakness or increase the competitive strength of the firms that are involved. Vertical mergers occur when companies merge to create a more integrated value chain. For example, firms in e-commerce and digital payments could be together in merger. Unrelated business mergers lead to conglomerate merger. Merger of firms with dissimilar businesses is the nucleus for starting conglomerate development. Conglomerate mergers were popular in the 1960s and 1970s. They were seen to provide economies of scope and in some cases economies of scale as well, besides de-risking and diversifying respective base businesses. Mergers also occur when conglomerates restructure their individual businesses for alignment and synergy. These mergers are called absorption mergers. The recent exchange of businesses between two Tata Group companies, Tata Fertilizers and Tata Chemicals on one hand, and Tata Chemicals and Tata Global Beverages on the other hand, reflect absorption mergers. Mergers also happen within the same industry when the firms are either equal or near equal in terms of scale, or a small company folding itself into a larger company. At times, a larger company also merges itself into a smaller listed company to get the benefit of immediate public listing. Merger of IDBI, a larger developmental institution, into its subsidiary IDBI Bank in 2005, and the earlier merger of ICICI, a similar financial development institution, with its listed subsidiary ICICI Bank in 2001 are two examples of the latter. ICICI merger has been a roaring success with a larger capital base, economies of scale and scope, and more effective consolidation as a universal banking corporation. Interestingly, ICICI Bank itself has led to several joint ventures and subsidiaries which built further value, as we have discussed earlier, in terms of subsidiarization and joint venture benefits, and also as would be discussed in this lecture. In contrast, IDBI merger has not been as successful as the ICICI merger has been. The merger of three public sector banks, Bank of Baroda, Dena Bank, and Vijaya Bank in 2018, and other follow-on bank mergers in 2020 are more recent phenomena. It is expected that there would be more mergers in the financial sector because the banks needed some kind of scale to be competitive nationally and globally. In this change, stronger and weaker institutions may get merged, or many weaker institutions may get merged into a stronger institution. The cycle of companies starting small, growing profitably or in a weak manner, and getting consolidated with bigger players is both a historical trend and a prudential necessity. There has also been a trend of mainstream automobile companies, each reputed and strong in its own right, combining to form a new powerful automobile entity. In the past, automobile mergers have been resorted to obtain economies of scale and scope and derive synergies. The big become bigger in automobile industry and also in pharmaceutical industry. Fiat Chrysler Automobiles has merged with PSA Group to form Stellantis recently. Stellantis thus became the world's fourth largest automaker with brands from both the pedigrees such as Alfa Romeo, Jeep, Dodge, and Ram, as well as Citroën, Peugeot, and Opel. With annual sales of approximately 8 million vehicles and 400,000 employees, the combined entity became the fourth largest global automaker by volume. PSA and FCA themselves emerged in the past out of several other mergers. The cycle of mergers continued in terms of Stellantis. Let's talk about amalgamation. I have here a case study of Tata Steel, which amalgamated several subsidiaries of its own into itself. Amalgamation is a special form of merger. Tata Steel announced on September 23, 2022, amalgamation within itself of its seven subsidiaries to create the world's largest steel making company. Tata Steel's equity holdings are given in the brackets in the graphic below. So the seven companies that are involved are Tata Steel Long Products Limited, in which Tata Steel had 74.91% share, the Tin Plate Company of India Limited 74.96% share, Tata Metallics Limited 60.03% share, the Indian Steel and Wire Products Limited 95.01% share, Tata Steel Mining Limited 100% share, S&T Mining Company Limited 100% share, TRF Limited 34.11%. Tata Steel released a note on the benefits of amalgamation. It said, the proposed amalgamations will enhance management efficiency, drive sharper focus, and improve agility across businesses based on the strong parental support from Tata Steel leadership. In line with Tata Steel's long-term strategy, the consolidation of the downstream operations will enable growth in value-added segments by leveraging Tata Steel's nationwide marketing and sales network. The amalgamations will also drive synergies through raw material security, centralized procurement, optimization of inventories, reduced logistics costs, and better facility utilization. On completion of the amalgamation, there will be further opportunities towards reduction of overhead and corporate costs. Each of the proposed amalgamations will be value accretive for shareholders. What this teaches us is that while subsidiaries may be set up initially for focus on certain businesses, amalgamation at a later point of time simplifies structure when those subsidiaries have fulfilled their purposes. Acquisitions involve takeover of a company or its business by another company, and that is intended to expand and diversify the acquirer. Basically, there are four types of acquisitions that can be considered: asset acquisition, division acquisition, bolt-on acquisition, and company acquisition. Acquisitions provide an opportunity to pick and choose parts of business that make good techno-economic sense for the acquiring company. In certain cases, the whole business is acquired for cash or stock or a combination thereof, while in some cases assets are acquired on slump sale basis. The range of acquisitions could vary widely depending on the scale and scope, from a few millions of dollars to several billions of dollars. Global pharmaceutical industry has been the hotbed of mega acquisitions, some of them cross-border. Large and mega acquisitions capture employee, investor, and public imagination and also take the entities to much higher trajectories. Smaller acquisitions, which are called bolt-on acquisitions, bring selective capabilities into the fold of the acquiring company, and these are also becoming more popular. When Orchid Chemicals and Pharmaceuticals had a range of capabilities, that is, from active pharmaceutical ingredients, dosage forms, drug discovery, novel drug delivery, and in different dosage forms such as oral solids, antibiotic injectables, and other such developments. Hospira, which had the opportunity to invest or to take out the business from Orchid in terms of chose to have a part of the business of Orchid carved out through an acquisition because it made sense for the company to take only a part of the business rather than the full business. Acquisitions offer this flexibility, whereas merger usually between two companies in whole. It is not that acquisitions do not have company acquisitions also as one of the possibilities. Then we also have the counter to that, demergers and spin-offs. Demergers and spin-offs post incubation and successful ramp up of subsidiaries constitute another mode of business development. Promoters, corporates, and conglomerate interests promote several related and unrelated businesses in their structures, and these are usually unlisted companies when they are established. Once the operations reach critical level, the parent company demerges its businesses. The demerged businesses are also typically listed. Spin-offs happen when a part of the business can be constituted as a separate entity with its own value chain, although within the same overall industry. Like mergers and acquisitions, demergers and spin-offs, when properly conceptualized and executed, can be transformational. Recently, we had a couple of examples of these kinds of demergers. Arvind, the clothing, apparel, and fashion company, demerged itself into Arvind Fashions and the Anup Engineering. Similarly, Adani Enterprises demerged Adani Gas and Adani Green Energy from itself. Adani Enterprises continues to incubate several new generation or new business companies, and at some point of time, they also may be demerged. An Indian pharmaceutical company can constitute its drug discovery operations as a separate entity and spin it off once a good product pipeline is built. ITC today has several businesses, each strong in its fold. ITC can represent a potential example of groundbreaking demerger and value unlocking if verticals such as FMCG and hotels are demerged. Well-timed demerger or spin-off of unrelated businesses can create value for all the entities, that is the parent as well as the subsidiaries, leading to fresh growth. Let's have synthesis of this. Collaborations, alliances, joint ventures, subsidiaries, mergers and acquisitions, demergers and spin-offs fulfill a variety of purposes. Choice of these business development platforms is contextual. These structures will change in appropriateness depending on internal and external context over time. Let us look at collaborations, primarily technical collaborations. They are a simple way to gain strengths for a consideration that is paid. These are independent in structure and strategy. They enable a firm gain strengths for a fee and royalty. However, the level of internalization that occurs with collaboration is very specific and time titrated. Strategic alliances enable companies to complement each other much more strongly. Strategic alliances help firms complement their strengths, pool costs, and share profits. However, the respective strengths and weaknesses of the companies remain as they were. Joint ventures help in driving new business formations. Transfer the capabilities of partners to a new entity for further development. Joint shareholding acts as the biggest constraint in driving JVs to perpetuity. Subsidiaries help companies drive new businesses without losing ownership control. We have extensively covered subsidiaries in the previous lecture. Subsidiaries provide unfettered access to the parent's resources while adding new specific strengths. Over time, a structure of multiple subsidiaries could become resource intensive and unwieldy, so there could be limits to which subsidiaries can be set up. Mergers and acquisitions, which we are considering in this lecture, help firms choose and merge or acquire firms with the required capabilities. Mergers and acquisitions usually result in a step function increase in capabilities. Mergers which are carried out based on all stock deals, that is, only issue of capital, equity capital, avoid immediate financial expenditure. Diversity of cultures, overlapping of activities, and non-accrual of synergies limit M&A effectiveness. Demergers and spin-offs are appropriate when the incubated ventures have great standalone business potential after they have reached their critical mass. It releases cash and resources, will inject fresh capital, drive fresh growth, and create market value. The timing of demerger or spin-off and potential loss of control and future value creation are debatable. All the above options, six of these which I have outlined here, help firms supplement themselves with other strengths or provide their strengths to others. They also help firms reorganize themselves structurally for better financial and business efficiencies. What is the responsible of the chief strategist or the chief strategy officer in business development platform selection and also getting the companies onto play in the business development platform? The strategist has the responsibility to evaluate various structures of business development and choose the right one. The CSO has to weigh in on the organic and inorganic ways of achieving growth for the firm. That is, should I set up a subsidiary? Should I go to a joint venture route, or should I consider a merger and acquisition? Or simply a collaboration or alliance would do the trick. The CSO must evaluate the appropriate sequence and mix of collaborations, alliances, joint ventures, subsidiaries, and M&A. Must be agile and opportunistic to pick up any exciting collaboration or acquisition opportunity that exists and that emerges, even if it is not in the agreed frame of strategic reference for the company. The processes of identifying a need, selecting a path, and zeroing in on a target for collaboration or acquisition involve both science and art of strategic management, because the processes involve not only technical analysis but also require emotional engagement. They require the firms to be patient and diligent as well as alert and apprehensive. While analyzing carefully, they must also pursue opportunities with excitement and enthusiasm. The multiple and seemingly conflicting factors can be addressed by processes that assure value in such strategies. A framework for mergers and acquisition in a national context. Mergers and acquisitions are the primary vehicles for step function growth. While alliances and joint ventures take their time to grow, mergers and acquisitions offer an immediate opportunity to enter a new area and or ramp up scale. First, you start with a proposal. How does the merger or acquisition provide value for both the companies? What is the opportunity that is available for merger or acquisition, and what is the affordability in terms of the acquirer's financial resources? Then we have the filters to consider. Any company cannot be merged or amalgamated with any other company. The jurisdictions of the nations have some important say in that. So there are requirements of the Competition Commission, there are requirements of global regulatory agencies. These have to be fulfilled. Then you go to the M&A phase, expanded scale and scope, expanded industrial and business presence. Mergers and acquisitions require that at least one party has the required financial power not only to merge or acquire but also make additional investments post merger. It is not that all the investments would have been made in the acquired company. So the company must keep aside a certain provision for continued investments in the acquired company. Mergers of equals is rare in the sense that even though the two entities may be able to have successful businesses, one of the entities tends to have access to superior cash resources to effect a merger or an acquisition as an alternative. In Vodafone Idea Telecom entities merger, although both the entities are large with reference to the respective national geographies, Vodafone obviously has greater strength as a profitable global player. It is a different matter why Vodafone did not bring all of its capabilities to the table in all the imbroglios that surrounded Vodafone Idea. Pfizer's acquisition of Wyeth is a case of Pfizer's superior financial strength overwhelming Wyeth's independent existence, although Wyeth had the ability to run as an independent company. At times, mergers and acquisitions can be very expensive. They definitely provide opportunities for immediate step function growth and major diversification, but they also tend to be expensive. But the other part, which is somewhat unsettling for the strategists, is that M&A could also lead to value erosion. There are as many cases of value eroding mergers and acquisitions as there are of value accretive ones. As with alliances and joint ventures, therefore, careful due diligence and framing of expectations is necessary. Mergers and acquisitions often lead to loss of institutional leadership of the weaker or smaller partner, leading to certain gaps in the development of new merged businesses. Many times, the business logic and the cultural mosaic of the weaker or the smaller party, that is the acquired party, fail to get the due recognition, although the success of the smaller and weaker factory may in fact have been the first trigger for considering the merger or acquisition. Some examples: a company which believes in being asset light and cash rich may still acquire an entity with strong manufacturing assets. What happens thereafter? The company would go by its playbook and pair the assets after acquisition. A strong marketing organization may acquire a powerful branded business, but In its hands, the brands may not be growing as they would have grown with the passionate entrepreneur who brought the brand up. An established company may acquire an innovative startup for its novel products and yet lose the founders who were responsible for such innovation. So, mergers and acquisitions involve not only technology, not only assets, but also the human element. The human dynamics of mergers and acquisitions are very important and they need to be appreciated by leaders. The biggest risk in mergers and acquisitions, however, pertains to clash of cultures. Depending on the longevity of the companies that are involved in the M&A, the cultural roadblocks could vary in intensity. If a company hasn't changed for 80 years, it is difficult to envisage that the company would be changing in a short span of 1 or 2 years. Then we spoke about regulatory filters earlier. Typically, mergers and acquisitions would have to go through the regulatory filters related to competition and antitrust considerations. National governments, of course, want make in the nation programs. They also want to encourage scale, but at the same time, the governments want to discourage formation of monopolies so that the consumer interests are protected. Among various industries, pharmaceutical industry emerges as the front runner in the mergers and acquisition space. Big Pharma critically needs R&D pipeline as well as entry into newer genetics-based domains for the long-term growth. Established companies with robust drug development pipeline and startups with novel therapeutic candidates in advanced clinical programs become targets for acquisition. Not only that, very specifically, global pharma majors are looking at acquiring biological capabilities so that they can have a significant part in the shift towards biologic drugs that is happening. Occasionally, and not often, tax considerations also influence merger or acquisition decisions. This was the case with the Pfizer AstraZeneca acquisition, which failed. Mergers and acquisitions do not have easy paths. The boards of both the companies have a respective responsibility to maximize value to the respective company shareholders. It is not uncommon for merger and acquisition proposals to take a couple of years or more to fructify. In some cases, they may get abandoned due to shareholder or regulatory issues, and it is also quite possible that some of these will be revisited and eventually the acquisition or merger activity gets completed. Companies which are resolute in acquiring do make repeated attempts, and equally resolute defenders do make attempts to spurn such bids. In India, L&T successfully resisted acquisition bids by Reliance and Birla Groups in the past. Acquisitions have to be tinged with realism. Given the high risks associated with mega mergers and acquisitions, firms tend to consider smaller transactions that bring specific strengths. These are called bolt on or tuck in acquisitions. An automobile company may seek to acquire a design studio or a bodybuilding plant, for example. A pharmaceutical company may acquire a precision medicine startup. Somebody may specialize in CRISPR technology, and that specialization may be bought over by another pharmaceutical company. Mergers and acquisitions are a great way to integrate across the value chain or diversify product and manufacturing strengths. As discussed earlier, successful experience by way of an alliance or partnership leads to mergers and acquisitions emerging as potential follow on options. As with alliances, the nature and quality of persons developed in the organization and the selection of the right nature and quality of persons to be used in joint venture process or M&A processes determine the success of mergers and acquisitions too. This domain requires a very unique set of skills and strategic thinking that gives due weightage to building successful relationships. Mergers and acquisitions, in addition, require that the initiating party has the required foresight to see the value and possess the financial strength not only to merge or acquire but also to make additional investments. Generally, mergers of equals is rare, even though the two entities may be able to have successful businesses. However, one of the entities tends to have access to superior cash resources to effect a merger or an acquisition, and that could be an alternative scenario. I talked about different kinds of mergers and acquisitions, but I want to present here All of these things and a few more in terms of clear single line descriptors and examples. Horizontal merger, mergers in the same business, Vodafone Idea merger into VI. Vertical merger, mergers in the upstream and downstream side, Flipkart eBay merger. Conglomerate merger, mergers in unrelated businesses, Walt Disney and ABC. Absorption merger, Tata Fertilizers and Tata Chemicals, consumer businesses of Tata Chemicals and Tata Global Beverages, where they exchange some products from one basket to another basket. Reverse merger, bigger company merging with the smaller company, ICICI with ICICI Bank. Amalgamation, a big company absorbs a small company, Ashok Leyland Hinduja Foundries amalgamation. Mega acquisition, a big company acquiring the business of another big company, Pfizer acquiring Wyeth. Bolt-on acquisition, acquisition of a small entity for accrual of specialist value. Tata Motors acquiring Trelix, a European design house. Transformational M&A, M&A with highly transformative impact or effect. Novartis born out of Sandoz and Sibagiji merger. There are also specially structured M&As. M&As that take place in India under special regulatory process like Insolvency and Bankruptcy Code, IBC, or NCLT, or such ones. Tata Steel, Bhushan Steel, and a host of such NCLT and NCLAT cases under IBC have resulted in mergers and acquisitions in a significant way. Why do we do mergers and acquisitions? We do mergers because they provide strategic advantage. Many top ranking firms have reached the kind of scale that we see for them by the merger of firms with complementary capabilities. If such capabilities exist in the marketing arena, there also the impact will be immediate. Therefore, the M&A movement is not functional. It is cross company. There could be technology driven merger of R&D or manufacturing. In this case, the investment risk reward is linked to the scale and scope of the product portfolio. Synergy in such ventures could be limited by marketing capability for the combined portfolio. That is, you created a huge technology behemoth, you created a large manufacturing imprint, but eventually you need marketing capability to take that into the marketplace. You can look at only a commercially driven merger of marketing that could offer immediate marketing boost through portfolio and customer expansion. However, long-term synergy of such a move will be linked to R&D and manufacturing support to leverage the broader marketing capability. Ideally, you should have a value chain merger of R&D, manufacturing and marketing. This could offer the highest benefit, but the risk reward equation will be at a high level. Problems of overlap could exist, synergy could be diluted. Managerial bandwidth will be under test. Generating value out of M&A has not been easy in practice. The benefits on paper tend to get eroded due to issues in execution. While securing portfolio breadth, legacy regulatory problems may also be acquired. How do you judge how much would you need to pay for an acquisition? This is a simple representation. Let's say a company acquires another company and we do the business plan for the company on a standalone basis and on a merged basis after the acquisition. We can do this for 5 years or 10 years or any number of years you would like to do. So in the blue bars, you have the standalone cash flows prior to acquisition. And in the violet bars, you have the incremental cash flows because of M&A. Both of these, that is the standalone cash flows prior to the acquisition as well as the incremental cash flows because of M&A, have to be reduced to the respective net present value. But what you have in terms of your negotiating range is the NPV of incremental cash flows because of M&A. As an example, if your cumulative cash flows in NPV terms is $2 billion and you are getting an incremental NPV cash flow of $3 billion and you have to invest, let's say, $6 billion in this venture, you have to see how the incremental value supports the initial investment that you are making. So this is a business plan calculation utilizing the principles of discounting of the future cash flows. We got to use weighted average cost of capital to make this calculation. In spite of all such financial calculations, there is always a likelihood in M&A that potential synergies are overestimated, while mandatory but unanticipated investments are underestimated. This happens during the M&A time span when these benefits have to come and when these investments have to be made. This leads to valuation errors. I mean, you cannot do anything to undo whatever has been happening through the purchase of the asset. What you can do is to have higher value getting generated through the acquisition. Usually, there is no one good price that can be put on an M&A transaction. Several factors can make or mar viability in course of time once the price is paid upfront. Now let's look at the specific case of the Indian pharmaceutical industry. Indian pharmaceutical industry is a highly fragmented industry. In one of the earlier lectures, we have seen how fragmented the industry is. Even if you look at the top ranking companies, it is a great achievement if one company has more than 5% market share. That is the level of fragmentation that is there in the Indian pharmaceutical industry. But Indian pharmaceutical companies have also been integrating or expanding their footprint through mergers and acquisitions. The rationale has been sixfold. Therapeutic diversification, that is, if you are a cardiology company, you are getting products in the respiratory division that way. Product expansion for all the markets, global diversification, especially in US, market expansion, especially in India, and regulatory de-risking. And once an M&A occurs appropriately, the valuation would improve. Distressed assets can be bought over and can be turned around. And what are the enablers for the Indian pharma acquisitions? Not everybody could do the acquisitions. The cash position of the company, ability to raise funds and maintain profitability, sustained revenue and profitability generation capacity of current and future businesses, payback potential, and strategic fit have been the great enablers for this kind of M&A. Along with that, synergy has to be realized, value has to be accretive, and growth potential has to be sustained. The Indian pharmaceutical industry in general has been more outbound towards US and Europe rather than inbound within India in its alliances and M&A, despite the fragmented industry structure. And huge multiplicity of brands and large domestic market crying for consolidation is an unfortunate but certain fact of the Indian pharmaceutical industry and the marketplace. Let us look at two, three cases. Here we have Torrent, a respected name in the Indian pharmaceutical industry. We also have Elder, a niche player in the pharmaceutical industry. Torrent is a highly diversified company having presence in CNS, that is central nervous system drugs, gastrointestinal drugs, antidiabetics, anti-infectives, women's healthcare, pain, gynecology, others, and cardiac 37. So if you look at the company, it is a significant specialist in cardiac, CNS, and gastrointestinal medicines. These things together accrue for 73% of the company, right? If you look at Elder, you will find that it is a nutraceutical oriented company and women's healthcare company. 68% is derived from these product groups. It is also strong in pain, 21%, gynecology 5%, others 6%. When Torrent and Elder combined with each other, there has been a significant churn in the way the therapies are positioned in terms of contribution to the merged entity's value. Cardiac became 28% from 37%. CNS also reduced to 15%. Gastrointestinal to 13% from 16%. Anti-diabetic marginally the same at 5%. Anti-infectives down from 10% to 7%. But nutraceuticals and women's healthcare got a big leg up. It moved from 5% to 18%. Similarly, the pain group moved from 4% to 8%. Others moved to 6% from 4%. So this is how the therapies benefit by two companies operating in different therapeutic segments decide to come together. Not only that, because of this, the market share improved. The IPM market share before the acquisition for Torrent was 2%. After the Elder acquisition, it became 2.7%. Sales rank improved from 17 to 12. In the nutraceuticals and women's healthcare market, Torrent was marginally present at 0.4%, but that percentage became 6.2. In the pain management also, the market share improved from 0.9% to 2.7%. The access ranks for gynecologists, orthopedicians, and surgeons significantly improved. Another important aspect is that the per capita productivity of an individual marketing representative went through a significant leg up. That is, the per capita productivity per month in Indian rupees moved up from 290,000 to 620,000. And if a single representative is able to sell more products, obviously the financial viability of the company would improve and it would start taking back the investments it has made through the returns and positive cash flows. Sun Pharma's acquisition of Taro, an Israeli headquartered company with significant operations in the United States, has been a game changer for Sun Pharma. You can see the 10-year financials here in US dollar million. The sales doubled, the EBITDA tripled, the EBITDA margin moved up significantly from 28% to 48% for Sun Pharma because of the Taro acquisition, and the present value has also moved. This shows that the profile of the candidate is extremely important. Sun Pharma chose Taro because it will get the company into the dermatological field and also provide good market presence and good market leadership. Return on capital is an astounding 641%, even with a cost of capital of 11%. Terminal growth rate was assumed at 2%, and payback period is extremely small at 3 years. Another example, Sun Pharma and Ranbaxy. You can see the therapies in which Sun Pharma has been strong and therapies in which Ranbaxy has been strong and therapies in which both were equally strong. And combined, you will see that four ticks permeate all the therapeutic areas, whereas earlier it was 4 for Sun, 2 for Ranbaxy, or 2 for Sun and 4 for Ranbaxy in a kind of differentiated manner. Now all that has been bundled together to provide the widest possible portfolio for Sun Pharma with Ranbaxy. This graphic illustrates this even more tellingly. Prior to the acquisition, Sun Pharma was an out and out chronic diseases company. That is, diseases which linger in our bodies for a long time. Diabetes, pulmonary situation, that is asthma and things like that. So Sun Pharma was a leader in cardiac, 19% contribution, diabetes 11%, and CNS 27%, much like Torrent Pharma. People say that Torrent tried to replicate Sun Pharma's business strategy and marketing strategy, of course, in its own way. And gastro was 14%. Otherwise, there were no significant therapeutic leadership materials in Sun Pharma. However, after the Ranbaxy merger, while cardiac reduced to 16% and diabetes reduced to 18%, there has been a significant new group called anti-infectives that came in. Similarly, while CNS reduced to 16%, there were several other groups which came in a big way and helped the company out diversify its product platform. Not only that, the geographical diversification of revenue base after the acquisition has been illustrative. Sun alone was having an revenue contribution of 23%, rest of the world of 17%, and US gave the company 60%. While it is an advantage at one level, it is also a risk at another level. After the Ranbaxy acquisition, the whole thing's changed. That's because for Ranbaxy, rest of the world was 50% and US was only 29%. India was a healthy 21%. So Sun plus Ranbaxy, when you compare the graphic on the left side with the graphic on the rightmost side, you will find that it has now a more equitable distribution. Rest of the world 31%, India 21%, of course, remaining at the same level, and US at 47%. The top 10 acquisitions in Indian pharma over the last 5 to 6 years have been as follows. Sun Pharma and Ranbaxy, 2014, $4 billion. The reason was scale and scope. Abbott Piramal, 2010, $3.72 billion. Again, different objective, capturing Indian market. Daiichi Ranbaxy, year 2008, $4.6 billion. The goal was US market expansion and de-risking Indian plant issues. Lupin Gavin was not so successful despite the attempt to de-risk India plant operations. Lupin Biocom Russia, entry into Russia was the objective. However, I don't think it achieved what it wanted to achieve with this. Sun Pharma, Taro Israel, 2007, USD 450 million plus for entry into Derma and US, Israel and Canada. Dr. Reddy's with Betaform in 2006 suffered a significant blow in the M&A space. It lost almost all of its $480 million because the concerns or the regulations for public bidding of tenders has completely changed. And that dealt a body blow to Betaform's acquisition by Dr. Reddy's, because at that point of time of acquisition, there were no such barriers or requirements. So it was decided to look at European generics market through Betaform, but that impact hasn't arrived as they expected. Cipla acquired Invagen and Exelon for US A&A pipeline and US manufacturing. They are doing reasonably well. Then we have Mankind acquiring Panacea in 2022 for USD 253 million to focus on the exports of pharmaceutical formulations in the United States. In the past, as well as more recently, there have been many other pharma mergers and acquisitions which are below $1 billion. Intas with Teva, Dr. Reddy's with Teva, Strides Alcolab with Shasun and Aspen, Australia, Jubilant with the Drakes, Piramal with Malincroft, Zydus Cadila with Sentinel Therapeutics, Arabindo with Nairobi, Cadila Health with Torrent, and Sanofi with Shanta Biotechnics. All of these constituted follow-on strategic actions in terms of mergers and acquisitions. Some of them have helped the companies acquire new competencies which they didn't possess to the extent that was required. For example, Sanofi gained by having Shanta Biotechnics for vaccines development and providing a manufacturing base for emerging markets. The key takeaways from the Indian pharma M&A cases are as follows. Sun Pharma Ranbaxy merger that happened in 2014 is a classic case of the strategic intent being right and also getting fulfilled. That is to become a top 5 global generics company and achieve therapeutic and geographical distribution. But the deal itself became a huge value destroyer for Sun Pharma due to multiple regulatory issues faced by Ranbaxy for years. On the other hand, Sun Pharma Taro merger in 2010 was an analyst's delight, with the strategic intent being fulfilled, Derma entry and US expansion, along with very quick payback and improved market valuation. Sun Pharma, in fact, grew over the years based on 16 M&A transactions until the Ranbaxy transaction destroyed huge amount of value. Points to the need for objective due diligence being more important than subjective promoter aspirations. Torrent Elder M&A 2014 is an interesting M&A which delivered standing and value due to a combination of focused strategic intent, reasonable complementarity, and excellent integration management. Indian pharma certainly doesn't have the deep pockets of big pharma to take impairments in case the M&A go through successfully. And also they did not have the deep pockets to follow up failed M&As with successful M&As. That is, it is not possible for them unless again they spend a lot of money to station themselves in the host country to incentivize and train the employees to become something different when they get into a newer jurisdiction. The need for professional caution tempering entrepreneurial aspiration in M&A activities is very much self-evident. So you can look at Indian pharma acquisition experience as a bittersweet memory or a bittersweet happening. There have been successful turnarounds and value creators, Santaro, resulted in therapeutic and geographical growth. Torrent and Elder resulted in process optimization and cost savings. Arvindo several. This resulted in portfolio expansion and market reach. There have been also unsuccessful turnarounds and value destroyers. As I said, Dr. Reddy's Beta Farm acquisition was too expensive and was adversely impacted by dramatic price controls in Germany that got announced soon after. Sun Ranbaxy we considered too expensive and negatively impacted by regulatory and compliance pitfalls at Ranbaxy. Lupin Gavin, it was very expensive and revenues did not justify the price paid. Let's look at very recent ones. Top 10 deals by value in the Indian pharmaceutical acquisition space. Mankind, one of the largest pharmaceutical companies currently in India, has acquired Panacea for $253 million. Torrent acquired Curatio Health for $250 million. All the other have been less than $100 million. JB came Sanzyme, Eris Life, Oaknet, Dr. Reddy's, Novartis brands, Lupin Anglo-French brands, JB came Razel, JB came Novartis brands, Boehringer Ingelheim, Lupin brands, and Hetero J&J unit. If you look at these kinds of acquisitions, we can say that we have seen 16 deals during 2022 worth nearly $1 billion. Most of these M&A deals have been backed by private equity investors. A classic example is JB Chemicals. There has been a significant investment in JB Chemicals which enabled the company to look at these kinds of bolt-on acquisitions. Among these, the largest deals include Torrent's buyout of dermatology firm Curatio based in Chennai and Mankind Pharma's acquisition of Panacea's domestic formulation brands. Mumbai-based JB Pharma made 4 deals, the latest being the acquisition of Glenmark's cardiac brand Razel in India and Nepal. Most of the M&A transactions have been done by Indian pharma companies. Multinational pharmaceutical companies, on the other hand, have been the net sellers in the branded generic space. This is usually an outcome of their global portfolio rationalization, and they would have undergone mergers, and the merger conditions could have been to rationalize the product portfolio and sell off certain brands to other competitors so that there could be consumer interest protection as part of the merger. Let's shift gears to the big pharma. There have been some strong big pharma M&A in recent years. However, the big pharma M&A has never been a new phenomenon. It has been there for several decades. And the deal values also have been astounding, even 20 years earlier or 30 years earlier. These deal values and deals that I have shown here guide you to the fact that many of the deals have been in the vaccine and biologicals area. There have been very few deals that have led to two generic companies coming together, as was happening in the previous 6 years. At that point of time, we had Teva undertaking an acquisition, Pfizer undertaking an acquisition to expand the generic portfolio. Such deals have reduced, and now the interest is more in terms of drug discovery. If a whole product cluster is taken, or if a whole company is taken, the values are really upwards of USD 10 billion. But smaller product clusters or drugs in the pipeline could be taken for $1 billion to $10 billion kind of prices. Typically, product pipeline requirements, including therapeutic diversification towards biologics and synergies, that is cost savings, drive large and M&A transactions in big pharma. The reasons for big pharma M&A are quite visible and known. Increasing time and cost of new drug development. A drug costs 1.4 to 2.6 billion over a 10-year development period, and some drugs could even cost more. This is because of the increasing cost of R&D investments over the typically multi-year organic route. On an average, big pharma spends at least 20% of its sales on R&D. That works out to $2 to $10 billion for an average company. The biotech startups that have come up to discover and develop novel, innovative medicines have become attractive to supplement organic product pipelines of big pharma companies. And also, mergers and acquisitions help the big pharma reposition themselves strategically in terms of therapies. more particularly from narrow to broad therapeutic profile, from conventional small molecules to biological large molecules. Need to protect and grow revenue and profitability and remain in industry top league. Move from mid-scale to large scale and overcome competitive weaknesses. Efficient capital allocation through R&D and D and manufacturing synergies at industry level, and restructuring of business with refocused business objectives. Again, typically product pipelines requirements, therapeutic diversification requirement, and synergies, that is cost savings, drive large M&A transactions in big pharma. And when two strong commercially oriented or market oriented companies come together, there's usually again a huge rationalization of the medical representative network, leading to a lot of cash savings for the companies. Pfizer is a leading global pharmaceutical company, and its growth has been largely through acquisitions. Here, I have not given all the acquisitions. Some foundational acquisitions have been stated. Its acquisitions in 1999 with Warner Lambert, 2002 with Pharmacia, and 2009 with Wyeth have been game changing because they provided some of the blockbuster drugs for Pfizer to grow. Its taking into its fold of Hospira, a global generics player, was also game changing because the generics portfolio substantially got diversified and its position in manufactured injectables medicines has moved to much higher level. Later on, Pfizer began acquiring biologics based companies in a strong manner. Pfizer's sales revenue in 1998 was $23 billion, which increased to $54 billion in 2018. However, today, of course, post COVID vaccine success, it has notched up a sale nearing $100 billion. During this period, the company invested as much as $300 billion on various deals. But these investments cannot be looked at only in terms of dollar to dollar equation. The context of the company, the foundations of the company, and the future readiness of the company dramatically improved as a result of these acquisitions. That is the value that acquisitions provide to companies. But why Big Pharma are able to do this? Because they are not held by promoters as we know in India. These are widely held companies. Private equity players could be there, or the whole shareholding could be widely diversified. Issue of paper, commercial paper, bonds, or any other novel instrument to finance mega acquisitions and mergers is not difficult in the US environment and for big pharma. And that is one of the reasons which provides inflow of funds to fund mega acquisitions as I have outlined. There have been several noteworthy mergers and acquisitions in 2022. Tata Group acquired Air India at a cost of $2.4 billion. Elon Musk acquired Twitter at $44 billion investment. PVR merged with Anox. Adani Group acquired NDTV and took a stake of 37.45% and made an open offer. Today, it is having 65% plus shareholding in NDTV. Adani acquired Ambuja Cements and ACC, catapulted itself to number two position because of the acquisition, and the company spent $10.5 billion on that. The biggest merger in India is going to be the HDFC Bank and HDFC Investments and HDFC Holdings. That is, HDFC as the housing finance institution and HDFC Bank are going to merge, making one large banking monolith. $40 billion is the estimated value. Zomato took Blinkit under its fold for 568 million. Broadcom took VMware in its fold at staggering $61 billion. Oracle took Cerner at 28.3 billion. And Microsoft Activision Blizzard acquisition was of the order of 69 billion. And does like that, there are several acquisitions that have happened in 2022. And this trend certainly will continue over the next few years as well, or as long as industrial development is there. Mergers and acquisitions at different scales of investment would continue to happen. The path to alliance and M&A value creation, you would have seen a similar path in respect of strategic alliances and joint ventures. You will see a similar path here, but the path is with a few steps which are important. First, you have to familiarize yourself as companies. Executives of both companies have to know each other, build rapport, and ensure that they protect the respective company interests but also understand the interests of the other company. They should empathize with both the company needs. Then, once the deal is done, there must be integration. Understand in depth process of both the company's partners, develop hybrid processes that meet global and local needs, set up steering committees and program management offices. Then, as the integration becomes a transitory activity, that is changing the structure, nature, and culture of the company, you got to provide operational handholding, secure mutual alignment, depute parent employees for long periods, develop agendas and execution plans, demonstrate success with low hanging fruits, optimize through accomplishment of synergies, enhancement of capabilities, driving of revenues and profitability, and integrating into global network. And finally, the entire M&A activity has to conclude taking it to a next higher level of transformation, a new sense of purpose, a new strategic plan with a new trajectory and create a new entity. And this path to alliance and M&A value creation will happen when the leadership has got appropriate capabilities. The leadership in acquirer is extremely important. Instant collaboration by local partner has to be assuaged. The mutual mindsets have to be opened up, and there should be leadership for collaborators and facilitators. There could be execution specialists, but they must be problem solvers and change agents. Accountability management is important. Efficiency experts are important. New cultural anchors are required while you are undertaking transition. And optimization requires visionaries, strategies, and global executives. And persons who deal with M&A have to display these personalities in different shades as they go through the M&A activity. The value creation in M&As is not just the net present value which I have shown earlier. There would be short-term value creation through revenue and profit addition certainly, but there would also be a tax shield. There would also be improved financial ratios. The long-term value creation comes from joint development of products, cost-effective global manufacturing, and even global market development. That is the long-term value creation. Given the importance of M&A, it is important that we all understand a framework for successful M&A. And for your benefit, I am presenting a framework which will ensure that M&A will be successful. There are five aspects of integration in any M&A, and integration is the most important phase of M&A. If integration fails, the M&A would fail. The first element of integration is vision and values. The best practices are to reconfirm the shared vision through leadership meetings, clearly articulate shared values. The next integration element is strategy, and the best practices are to develop detailed business and functional plans with metrics and milestones, develop a phased integration program stepwise with milestones, metrics, aim at low hanging fruits for early successes which will inspire both the companies to integrate better, begin executing on medium and long term growth plans. Then the next integration element is the structure and systems. Redefine business and organizational structures, establish the best possible business process, including empowerment and accountability, select the best leadership from both the partners to lead the change, handle organizational issues perceptively and swiftly, develop IT and digitization from the early stages of integration, establish a project management office because the entire task of M&A is a multi-year task and across the company value chain. Therefore, you need to have a project management office to monitor. Culture is the fourth important aspect of integration. Strive to retain the best parts of both the culture. Let not one culture bulldoze the other culture. Every culture will have some good points. Some may have those points in a greater measure, but that doesn't mean that the other culture has to be rooted out. You got to retain the best parts of both the cultures. Eliminate any disruptive facets of culture, even if it is that of the acquirer. Identify and articulate cultural anchors. Keep communicating on culture. Cultural transformation doesn't happen if there is no continuous articulation of the need for cultural change. Another important final element is the leadership and governance. You got to select the best in class leaders with equitable representation of the partner and the JV interests or the M&A interests. Establish a strong board with a good mix of investor directors and independent directors. Develop succession plans, including global career development plans as applicable. This is required for a successful M&A. We have seen several reasons why collaborations, alliances, joint ventures, subsidiaries, and M&A are needed as business development platforms. But let's try to crystallize or synthesize all of these drivers into a few notable ones. The first important aspect is capital efficiency. You got to have collaboration so that you are able to deploy cash well. Second, you have to have market access. Third, you need to have manufacturing competitiveness. You got to improve your product development. And finally, you have to de-risk yourself globally. They are not in any particular order. One company may require capital efficiency to a greater degree compared to another company, whereas another company would require product development throughput as one of the prime considerations for any of these five types of business development platforms. And the third company may require market access as one of the important aspects because it has got adequate product development capability and adequate manufacturing infrastructure. And as you go through these collaborations, alliances, joint ventures, subsidiaries, and M&A, you have to move from dependence to complementarity to synergy. When the companies involved move from dependence to synergy over a period of time, and when these five drivers are fully leveraged, the best possible value from any of these business development platforms will get accrued to the participants of these business development platforms. So, coming to the end of this lecture, let's compare the business development structures that I have proposed in this thematic lecture of this week, which focused on business development structures. There are six possibilities. You can have an internal division, that is something which is not a legal entity to undertake business development. You can have institutional collaboration. You can have strategic alliance. You can have a joint venture. You can have a subsidiary. And you can go through merger or acquisition. Let's look at these things in terms of six factors. In respect of internal division, ownership is your own. You own company, you own the division. In institutional collaboration, there is no issue at all of ownership because you don't have a separate entity created through a technical collaboration or even a financial collaboration. In respect of strategic alliance, again, there is no ownership issue. But when you look at joint ventures, you have ownership issues. You have to see how you will put in your respective equity capital into the joint venture. Subsidiary, there is no ownership issue because it is a part of your company, but it requires 100% capital commitment from the parent company. In respect of merger or acquisition, it is an exercise which is completely and highly investment intensive. The marketing impact, in respect of internal division, it is just proportional to the products and people that are deployed. In respect of institutional collaboration, major beneficial impact through big customers. Strategic alliance helps pooling of capabilities and resources of partners. Joint venture has the best possibility to develop a new culture, a new business focus, and a new infrastructure. However, it requires capital structure, capital support for long-term growth. In respect of subsidiary, marketing as a business driver, for example, requires capital support and leadership. Any other subsidiary also will require support, and that has to have some capability to be seen different in the industrial firmament. If subsidiary is seen to be the same as the parent, then the benefit of setting up a subsidiary would not be accruing. As I said in respect of Kaplan Point, Kaplan Point was a diversified pharmaceutical company with strong presence in the oral products. And by having a subsidiary of sterile products, Capilin Steriles, it has provided the necessary differentiation for setting up a subsidiary and value creation as well. And in respect of merger and acquisition, we need immediate marketing boost and portfolio diversification. What are the opportunities and limitations in each case? As far as internal division is concerned, it is limited to company's own portfolio. Institutional collaboration is linked to the requirements of the partner. Strategic alliance certainly optimizes resource consumption because each bears its costs and shares the profits. Helps channel resources as applicable to product development and market development, particularly for Indian partners. Joint venture enables long term strategic independence, could be restrained only by ownership issues. We have seen the example of Hero Honda having ownership issues. Subsidiary, same as internal division, but with much higher potential for standalone value creation. Enhances critical mass of growth. It catapults the firm much higher. It will be a step function increase in performance and potential. The strategic marketing drive in internal division will be low, institutional collaboration low to medium, strategic alliance medium, and as you move towards joint venture, subsidiary, merger, or acquisition, the strategic marketing drive, that is to make a success of the new entity created, will go and grow by leaps and bounds. And therefore, the strategic marketing drive will be either high, as in the case of joint venture and subsidiary, or very high in respect of merger and acquisition. The reward level low, medium, high in respect of the internal division, institutional collaboration, and strategic alliance will be high, and high in respect of joint venture and subsidiary, and very high in respect of merger or acquisition. The risk level also will be changing. Internal division carries the lowest level of risk, just as institutional collaboration also carries the lowest level. But strategic alliance somehow comes up as a golden mean. It has a low level of risk but high level of reward. That's why many companies try out strategic alliance as the golden mean before going into a joint venture or any other ownership driven entities. In respect of joint venture, the risk is medium, reward is high. In respect of subsidiary, the risk is high because whatever the subsidiary does or fails to do gets reflected on the parent company. The risk is high, the reward is also high. And in respect of the merger or acquisition, the risk is medium if the due diligence is done well, and the reward is very high. That's the reason why big companies which have got finances, funding capabilities, and the managerial bandwidth go straight away for merger or acquisition to boost their future prospects. With this, we come to the end of this very important lecture on mergers and acquisition. Thank you for your kind attention. We will meet in the next week's lectures.